Hey traders, welcome to Charts and Coffee. All right, the big thing on the agenda today, what we're going to be dealing with, at least for the early part of the morning, is the digesting of the non-farm payroll number. And as you can see here, there's two things going on. So by the way, this is Forex Factory, and this is the calendar that I like to use for economic events. You can see here that there's a 307 to the far right, and hopefully that's pretty easy to see on the screen. Take a peek here. This was revised upwards. So these numbers are fairly hilarious, right? We get a number today, and then next month they might revise it. And that's exactly what we have here. So the previous number, this is the jobs report for January, right? The December jobs report it's a pretty significant revision from 256 to 307. All right, so the current number, at least it's going to be current until the next release. We expected 169, we got 143. Now, not everybody expects 169. You'll see banks have their estimates. There are all sorts of estimates out there. This is just a pretty decent forecast, maybe even consider a consensus. And that's at 143. All right, that's a miss. So that's all we need to know right now, if at all, because the place that I'm going to be looking at most, let's jump on over here. There we go. The place that I'm going to be looking at most is the 5-minute chart. You can even look at, whatever time frame you want. I'm usually on a 5-minute time frame for intraday, or even this is actually a 1. So I'm showing you a really immediate reaction to the economic event. All right, so take a peek here. So 1-minute chart, 8:30 comes, and I want you to see just how quickly we get these crazy wicks at 8:30. Now, this is not the trade, gang. I don't want anyone thinking I'm trading non-farm payroll. I'm absolutely not. Hang on one second. I'm going to close a couple programs that I've got running in the background right now. All right. So here comes 8:30. And there it is. Okay, so here comes 8:30 on the 1-minute chart. See this wick here? That's the initial reaction. And I'm not saying it's a forecasting of any sort, but just to give you an idea of the kind of range and volatility we get in the first 60 seconds. Take a breath, wait 60 seconds. I would even say wait 1 to 3 minutes. Just let everything sort of settle down. And you'd see in the next 3 minutes, so 8:30, 8:31, 8:32, 8:33, by the time we start that third minute, we're already starting to see some stabilizing, that the support seems to be holding, and then we're starting to climb higher. Why would equities, this is the S&P futures, why would equities climb higher on a miss in non-farm payroll? That has to do with the macroeconomic environment that we're in. In other words, what's the Federal Reserve going to do? Well, we know they're going to cut likely at least one more time, maybe twice as we go forward. And that expectation for the first cut just leapfrogged to better than a 50-50. This is definitely now a little bit better than a coin flip that we cut as early as June. Now, a lot of these expectations had been pushed out to even July. And then if you take a look at the end of the year, it's now kind of a better than 50-50 shot. We get 2 rate cuts as we go into the end of the year. So we don't want to we don't want to guess. We don't want to only focus on the highest probability. We always want to have the probability and another very likely possibility. And at this point, for sure, 1 cut is baked in, 2 is looking more likely. And by the way, again, differentiating between probabilities and possibilities. Possibility-wise, we even are looking at 3, but probably not likely. 1 to 2 rate cuts continue to be the narrative. And whenever we have a miss in data, that's what this is. In this case, it's a miss in the jobs number. What this signals to traders, and then traders and investors signal to the Federal Reserve, is your current monetary policy messaging. What we think you're going to do is not good for jobs, right? That's kind of the messaging. So you've got to adjust your messaging and then eventually your policy to account for the fact that the jobs number was a miss. So it puts pressure on the Federal Reserve. Why does the jobs number put pressure on the Federal Reserve? Bottom line, because ultimately the idea here is that they're still trying to make up their mind. And if we think about what more accommodation means and the fact that the Federal Reserve has a dual mandate, not just inflation, but jobs, again, when the jobs number misses, they got to think to themselves, at least for a moment, or at least shift up the messaging so they're not so rigid. We're still going to look at rate cuts. And guess what? Equities love that. So case in point, here goes the S&P, the NASDAQ, the Dow. I'd say the Russell is the most unimpressed, right? But we're definitely seeing more strength on the indices this morning. Dow, S&P, NAS are all above the previous session cash close. The Russell continues to struggle below it. All right, so that is what we've got going on. And remember, so this is Ben just mentioned from our Simpler Essential room, strains that yields are up on CME pricing rate cuts. So yeah, it's a great point you make, Ben. So let's talk about bonds for a moment. Whether it's bonds or notes, as a general rule, Ben, imagine looking at bonds and not presuming that bond traders are talking about this economic event, the current month. In fact, usually bonds tend to be factoring in 3 to 6 months from now. So what bonds are doing today have a lot more to do with where we might be in, say, May or June, even further out. So bonds are never talking about, I shouldn't say never. Bonds seldom are in the now. They're in the today plus 90 days, usually minimum. So don't be surprised when bond yields seem to be kind of odd in terms of their reaction to today, because they're very seldom reacting to today. They're really projecting out what today might mean 90 days from now. It's an odd thing, but it's a very common thing. And if you want to see, and rather than just taking my word for it, go back to September of last year. That was the 50 basis point cut from the Federal Reserve. Up until that point, bond yields, and you can see the ZB futures, were trending higher, which means bond yields were going lower. Then why all of a sudden in September did bond yields start to go higher as the bond futures, the ZB, or even look at TLT, started falling? Because they weren't looking at September. They were looking at minimum, really, basically November, December, right? And then in June, the bond yields were reflecting the upcoming cuts for September. And so that's a really good look at the way in which that 3 to 6 month sort of looking ahead tends to play out in the bonds, because a lot of folks were perplexed that bonds started falling after not just a quarter point cut, it was a 50 basis point cut, right? Federal Reserve was trying to get out ahead of the curve. And then you'll see bonds said, okay, and started going up in rates. That would seem out of sync if we think that bonds are reacting to now. They're pricing in expectations, usually a quarter or two from now. So take a look at that, and it starts to make a lot of sense. Great comment, Ben. I appreciate that. All right, let's see here. Questions. All right. Let's see here. Just trying to see if there's a question here. All right, I'll take a look at if there's a symbol you want to take a look at. If there is a symbol, or make sure you let me know the time frame. If you have a position, let me know, and I'll just continue to scan through the symbols. Again, S&P, NASDAQ, Dow, Russell, all moving to some degree higher. And I really want to emphasize, again, let's step back and look at, not just the current chop, but where we are. This is not a bearish market. I feel that there's way too much bearish conversation out there. Just because we're uncertain doesn't mean it's bearish, right? And just because we're in chop doesn't mean it still can't be bullish, right? So those are all things that I would step back and take a look at what we're doing. And this is another thing too, because I've seen so much bearish analysis, and I'm just getting to the point now where, I'm just going to call it out. On what planet does we have 4 sectors that are zero, below the zero line. In other words, negative return for the last 30 days. Just four: technology, oil services, oil and gas explorers, and semiconductors. Number one, really easy cue. Avoid stocks weighted in those sectors, right? Now, take a look at everything above it, all of these that are above. Is there a reality where, and I know that XLK and SMH are very important sectors, most especially to the NASDAQ, but when we look at participation, please don't worry about what ticks are doing or Trin is doing. And I've used those in the past. If you want to know if there's broad participation, it's not about advancers and decliners, gang. What it is about understanding which sectors are leading. The top of this list, I don't want to say leading as in know it where we're going, as in they're the leader. On this leaderboard, they're at the top. If I see certain names at the top of the leaderboard, it will oftentimes map to certain sectors and stocks and then indices that are lining up with that. KRE at the top of the list, kind of interesting. It might benefit the Russell. XLF at the top of the list, pretty interesting. It should benefit the S&P and the Dow. So we want to take a look at this list. And when this many sectors, the sectors that are heavily weighted in the indices, are above the zero line, this is not bearish, gang. Now, if there is an index that I would at least have a little bit of a question mark over, it would be the NASDAQ. It would be the Magnificence. It would be, tech. But again, when you look at the chop, this is bullish chop in the NAS. So whenever you hear bearish rationale, aside from the clickbait of some very low downside target, let's look at participation, because now if that guesswork happens to at some time be true, whoever's picking these crazy low targets out there, we can see the shift in the participation of the sectors. By the way, there has been a little bit of a shift for the last couple of weeks. I'd say the last week and a half. Only XLK and SMH were negative. Now it's being joined by oil and gas explorers and oil services. So that's something to know. Okay. In that side of the broader averages, oil and gas explorers, crude oil, natural gas, Exxon, Chevron, ConocoPhillips, those kinds of names, be a little bit more cautious. That's why I'd say if you're looking at semiconductors, be very cautious. If you're looking at things in XLK, like NVIDIA, Apple, Microsoft, be cautious, right? Because those are sitting at the bottom of that performance leaderboard. All right. So that being said, let's see here. Let me take a look at some of the symbols here. I just try to go first come, first serve on these symbols, gang. And the first one is NEM. And if we like gold, which we do, we've been long gold now for some time. We're looking at taking our February 14 and February 21 expiring GLD calls into expiration. I would love to see these continue. We've tightened up our stop here. And what does that have to do with NEM? Well, if gold is moving higher, GDX should be moving higher. Index sector, or in this case, commodity sector. And then lastly, stock. I would say, and we did a little bit of this work in the Sector Secrets Mastery, I'm probably a bigger fan of GDX right now over NEM. So great question, Jas. Rather than go with a high concentration weighted stock in the GDX, I'd rather just go with the sector itself, or what I like to call, I'll go with the tide, not an individual boat. All right, next question is Tesla on the daily. Thank you so much for the specificity, V. I appreciate that very much. All right, so Tesla on the daily. So Tesla on the daily means I'm looking for a setup, potentially, that would be a long call or a long put based on an overnight hold where it could be 2 to 10 days or longer. Now, Tesla is in a downtrend, right? It is in a downtrend. Tesla's been heavy. As of yesterday's close, it's a very fresh downtrend, but I want to point out we've been printing red bearish candles since the 27th of January. Once the candles on my top tier pro go red, that's just not a down candle, gang. That is a down candle with bearish participation. That's a heavy candle, and you can see how heavy Tesla's been. Now imagine if you had on your chart, consistent green, very consistent green up until the 31st of December, we get the first red candle. That's a warning shot across the bow, right? And we go red, green, and things got a little noisy. Neutral yellow means, look, the bulls aren't in control in a prolonged way, and the bears aren't in control in a prolonged way. We're probably going to chop around. That's exactly what we did. That neutral sentiment really started to dig its heels in, and boom, in this arm wrestle between basically 444 and about 372, boom, the bears won the arm wrestle. And imagine if you knew the red candles, if you knew that transition in the trend, and then now, instead of buying long calls, which worked great through November into mid-December, now you're saying, Rog, every rip higher into resistance, I'm going to buy puts. And that's the mode that we're in right now, V. That's the mode that we're in right now. Okay. So those are things to keep an eye on. All right. Next question is SOFI. All right. And again, anytime y'all are looking at a specific time frame, let me know. Otherwise, I will just default right to the daily. Red candles, that's a no-go. Yep, that's just a no-go. All right. I will leave this alone. This is where, and gang, so much of we just did a webinar. How many of you joined me for the webinar that we just did on Wednesday? And I walked through the importance of being able, and I'm trying to find the link so I can show you all. We're going to be, there we go. You can register for the webinar. We're going to be doing one on Wednesday at 2 p.m. So during market hours, which should be actually pretty fun because I could probably do a little bit of a live analysis after our discussion, like we do here in Charts and Coffee. So if you can check this, what is this? Consistency. All right. So you can actually register for that Wednesday session that's coming up over at simpletrading.com/consistency. And during that conversation Wednesday, this past Wednesday, it was 8 p.m. You can check the replay out at the Simpler Trading website. But we're going to have a brand new set of slides. We're going to have an updated look at the trades viz. This is not the same slide deck. This is not the same presentation. We're going to continue the conversation. So you probably want to check out the replay so you can get part 2 of this immersion 2025 trading that we'll be doing starting the 18th or 19th, okay? Look at what was, right? We trade what is. This is what was. And between end of September to really mid to end of December, this was an easy green buy the dip, oversold buy stock. It's not anymore. It's different. Now, you might say, Rog, we know that now. It's February 6th. How soon did we know this? I'll tell you right now. In fact, everyone watching knows, okay, Rog, can you put your mouse over those yellow candles? That's my first warning that things are going neutral, but they're bullish neutral, right? So the 30th and the 31st, boop, get our attention. Something's wobbling in that trend. Just that real time, quickly. All right. When did we know things were getting a little suspicious, a little choppy, a little bearish? Not the trend that it was on the 2nd of January, gang. And yeah, there was a nice rally through here, but this is still chop. This is no longer a trend. When did the trend end? The trend lost its swagger on the 12th of December. From the 12th of December on, you're looking at overbought, oversold. That expectation for the overall movement we saw end of September to mid-December is gone. Imagine if you had that kind of accuracy to say, oh, okay, Rog, I know how to buy the dip, right? And I know what to do. I have the tools. I've got to shift gears. It's a different terrain, right? Think of golf. This is a different shot, different club, different lie of the ball, right? So now I'm going to shift gears and use all my tools and rules and strategies about an overbought, oversold market. That's how quickly we have to be able, especially this year, we have to be able to assess what's going on. All right. Okay, gang, just like that, I'm out of questions. As always, gang, we start 9 a.m. Monday through Friday every morning, and we go to 9:20. Get those questions in early. I just go first come, first serve. There was one question that I missed. Let me just do this really quick. I missed your question, Yeshua. Bank of America. I can't do anything at a higher high, but think about what a green candle in the gray zone meant on the 3rd, and we'll be looking for another opportunity to get long. But please, in terms of what I want to do with Bank of America, this should really be, if you've got the long position, If you haven't already paid yourself, keep an eye on 48. That would be a level to at least proactively pay yourself and scale out and then see how much higher is high. Love this symbol though, my friend. It is an uptrend. Take a look at the multi-structure. When you automate the things that once upon a time for myself, I had to do manually. It's slow, it's cumbersome. It can be prone to errors, right? We can be emotional when we're doing things manually. When things are automated, we take these tried and true processes, we use all this great coding and these powerful platforms and say, look, I want to look at this like I used to 30 years ago, but with the automation that I could take advantage of today. And you'll see that all I need to do is glance at the green candles, glance at the green trend and momentum at the bottom of the screen here, and then take a look at my automated levels. That's where, for me, trading evolution can take us now. Not automatic trading, automated analysis. I'm a big fan of that. I still want to be the last person making a decision about it, but this is where we can be now in modern markets, and it's a pretty darn great time to be a trader. All right, gang, be good to each other. I'll talk with you soon.